Hey apes, what it do? It's me, Brandon. Oh, woo-hoo. Whoa. Oh, whoa. Just kidding. Honestly, just pooped a little. Anyways, let's talk about cost to borrow. I'm sure you've seen it, especially when it comes to AMC. It's high as heck. Heck, I say. Now, why is that? Well, stay tuned. Let's find out. The cost to borrow, also known as the borrowing rate or interest rate, is determined by the supply and demand of loanable funds in the market. The market for loanable funds is where lenders and borrowers interact to exchange money in the form of loans. The following is a brief explanation of how the supply and demand for loanable funds affects the cost to borrow. Okay, so this is my poopy diaper. God damn it, Kamala, throw my poops in the trash. You're embarrassing me. Sorry about that. Folks. Sorry, just pooped again. Anyways. The supply of loanable funds comes from individuals, companies, and governments who have excess money that they wish to lend out. The amount of supply increases as the interest rate offered on the loans increases. This is because higher interest rates incentivize more people to lend out their money, which increases the overall supply of loanable funds. Now let's talk about demand, as in, I demand you vote for me in 2024. Hey, just kidding, kinda. The demand for loanable funds comes from individuals, companies, and governments who need to borrow money. The amount of demand for loanable funds decreases as the interest rate offered on the loans increases. This is because higher interest rates make it more expensive for borrowers to borrow money, which decreases the overall demand for loanable funds. Now let's get into equilibrium. The cost to borrow is determined by the equilibrium point where the supply and demand for loanable funds intersect. At this point, the interest rate is such that the amount of money being supplied by lenders is equal to the amount of money being demanded by borrowers. The cost to borrow for a stock can be affected by the supply and demand for that stock in the market. When there is high demand for borrowing the stock and limited supply, the cost to borrow can increase significantly. This could be due to a variety of reasons, including short selling activity or hedging strategies employed by market participants. Short selling refers to the practice of borrowing shares of a stock from another investor, selling them on the open market, and then buying them back later to return to the original lender. Short selling is often used by investors who believe that the stock's price will decline in the future, allowing them to profit from the price difference. When short selling activity increases, the demand for borrowing the stock increases, which can drive up the cost to borrow. Similarly, hedging strategies that involve borrowing shares of a stock can also increase the demand for borrowing and drive up the cost to borrow. For example, a hedge fund may borrow shares of a stock as part of a strategy to reduce risk exposure to a particular sector or market. If many investors are using similar hedging strategies, the demand for borrowing the stock can increase, driving up the cost to borrow. In an efficient market, the cost to borrow should eventually reach an equilibrium point where the supply of the stock available for borrowing matches the demand for borrowing, resulting in a fair price to borrow. However, if there is significant short selling or hedging activity, the cost to borrow may remain high for an extended period of time until the market adjusts to the new supply and demand dynamics. Now here's a nifty little chart. It allows you to see the historic short volume on a chart, as well as the by exchange short volume percent. As you can see here, the average short amount has been relatively consistent for quite some time, around 56 to 58% of the daily volume shorted. This is likely the cause for such a high borrow cost, as the demand from apes remains persistent while the supply has been increased slowly over time. Despite the numerous outstanding shares increases from AMC, the cost to borrow still remains high, likely due to the fact that more investors are piling into the stock. Now, this is not a metric you want to use in order to see upside movement. Again, the short volume has been so high for so long, like me, that a high cost to borrow makes sense due to AMC's current supply and demand dynamics. Now, whenever the reverse split takes effect, depending on the ratio of the split, these supply and demand dynamics should change. I'll talk more about that in another video. The cost to borrow for a security can be high for a number of reasons, including market demand, supply of the security risk, and the prevailing interest rate. The cost to borrow can also be influenced by market sentiment, investor expectations, and changes in economic or political conditions. In some cases, the cost to borrow for a security may be driven up by the actions of banks or other financial institutions, such as when they are trying to manipulate the market or engage in short selling. However, it's important to note that such practices are often illegal and can result in serious consequences for those involved. In general, the cost to borrow is determined by the supply and demand for the security in question. If there are more people looking to borrow the security than there are lenders willing to lend it, the cost to borrow may increase. Conversely, if there are more lenders than borrowers, the cost to borrow may decrease. It's worth noting that the cost to borrow is not always an indication of market manipulation or wrongdoing by financial institutions. Rather, it is often a reflection of the supply and demand dynamics of the market, as well as other factors such as risk and interest rates. So basically, in essence, you already knew the answer. Crime, crime, crime. Oh. Crime time special, baby. Let's get him, Gary. Go gay. Go Gary. Go Gary. Go Gary. Anyways, yeah, that's cost to borrow for you. Gay dad, out.